Chapter 4. Investment in financial assets. This is an issue that often frightens ordinary people. I don't know how the stock market works. Error. The news says it's a good time to invest in the stock market. Error. The director, the bank manager, has recommended that I buy shares. Error. So many mistakes. Right? Relax, that's what this book is for. The stock market, investment funds, and in general, anything that is not something that can be touched, often scares people without culture or financial experience. This is normal. The images shown on TV show sweaty men wearing ties, throwing papers in the air, surrounded by a lot of screens. Nothing more alien to reality. The investment in financial assets is within your reach. In fact, I would say that it is too much in your reach. Later on, of course, I will develop its dangers. But for the moment, we are going to focus on its advantages. Let's put ourselves in the situation. You are in the interval, for example, of buying your first and second home. You have a job, and if you live with a couple, she or he has a job too. The monthly income increases, and there are no financial charges. Savings grow because expenses are contained, and money is not wasted on unnecessary things like a second car or a lifestyle based on appearing to friends, the best way not to prosper. Let's say you've managed to save $50,000 and it's deposited in your bank account. At that point, you will start getting a lot of offers to invest your money. The director of your bank will call you personally to make you feel important and offer you financial products that you have never heard of. It seems like you've entered another world. Stop. The first important thing. Never invest in something you don't understand. Imagine that you need to buy a new car, and the dealer offers you a drone car, which can fly if necessary. It's something new that just came out. Would you buy it? Logically, no, because you haven't seen any of these devices on the road yet, and you don't plan to compromise your safety and that of your family. This is the same example that we should remember when buying financial products offered by banks, without trusting grandiloquent concepts such as great opportunity, diversify your money easily and economically, reserved for large investors, professional managers with extensive experience. Scared? No, you don't have to be either. Investing in financial assets is within your reach, but it requires you to keep a cool head and not get carried away. Before starting with the different types of assets, we must clarify that our main objective is that one part of the money saved will work for us. At present, bank interest rates are close to 0%, and the prospects are that they will remain so for many years to come. Therefore, investment in bank accounts and deposits is out of the question because it will not offer us any return. And beware if they offer it to you. Always be wary of safe products with high returns. One of the saddest episodes of collective deception happened in Spain between 2009 and 2011. Supported by aggressive campaigns by their branch managers, financial institutions sold preferential shares to 700,000 clients with low-risk profiles, disguised as fixed income when in fact it was equities. On the hook of this operation was something as simple as the product being as safe as fixed income, but offering a much higher return. At the height of the transaction, the sale value of the preferred stock reached 30 billion euros. The problem appeared when these products, which were quoted on an opaque market, began to fall in price, and when shareholders, generally savers and not investors, wanted to recover their devalued investments. The Spanish government admitted that their commercialization was a failure, and the National Securities Commission has recognized that on many occasions the law was not being complied with. It is in dramatic cases like this that it is necessary to emphasize that the best weapon is information. In my case, the preferred stock scam happened very close to me, as both I and my sister, a very conservative saver, were offered to buy preferred stock by their bank manager. In my case, my investment profile was more risky, and it was not a product of my interest, but as I always try to be informed about economic and financial issues, I found in a specialized magazine some information that avoided the disaster in my sister's savings. The article said, in short, what was not made available to the public until much later, that a preferred stock is a security or share issued by a company, bank, savings bank, or financial company that does not confer any share in its capital or voting rights at the shareholders' meeting. It is perpetual, has no maturity, and its profitability is not guaranteed. Since it is linked to obtaining profits, it is, like all shares, variable income. They are called preferred shares because they have priority over other shares in the payment of dividends. However, when the liquidation comes, or in case of bankruptcy, the preferred shares may be the last ones. Their conditions are negotiated directly between the issuing entity, the bank, and the investor or shareholder. This is a very risky financial asset that can give high bank interest or large losses. Shortly after reading this article, my sister told me that her bank was offering to buy preferred shares. Of course, I advised her not to buy them, because I had read that it was a risky product, and that it was not in line with her profile. After a year, the bursting of the real estate bubble sank the balance sheets of the banks that had granted multi-million-dollar loans to construction companies to build hundreds of thousands of homes that no longer had a buyer. Preferred shares were no longer worth anything. This sad deception shows how important it is to be informed about the economy in general, and even more so about aspects of your personal savings, even if you only have your money in a bank deposit and don't think about making any investments. As we have seen, scammers come to you and are very clever, sometimes even disguising themselves as friends like bank branch managers. Get informed about the current economic situation. Always compare the information between various sources. Nowadays, there are multiple sources of economic information online, but if you prefer to read in paper, most newspapers come on weekends with a salmon supplement. That's how the economy pages are called. At this point, we will introduce a new section. What part of my savings can I allocate to investment in financial assets? At the beginning of the book, I stressed that in order to have a healthy financial situation, you should be able to live off your saved money for at least 5 years. Just as there are fixed and immovable elements that cannot be changed, such as not getting into debt with the banks to buy a house more than is necessary, and never to acquire consumer goods, financial investment is going to be the most flexible element of the whole. Moreover, we will always be able to undo our investments and recover the money. And what is the purpose of these investments? Of course, to make a profit. Yes, to make money, you heard it right. If you have acted wisely in your first economic steps, you can now take the leap and diversify your income. Not only are you going to be a worker who does his job well, but you are going to be an investor who gets a return on his money. Your savings will work for you. Unlike tangible assets, like a house or a motorcycle, financial assets usually have no physical value. The buyer of a financial asset has a right, an asset, and the seller has an obligation, a liability. From that contractual right arises the value of the financial asset. The objective of the seller of financial assets is to finance himself. The objective of the one who buys financial assets is to invest money in order to obtain a return on that money. A clear example is the state bonds, which serve to finance the country, thanks to the people who buy those bonds. The characteristics of financial assets are basically 3: liquidity, profitability, and risk. Depending on what type of financial asset it is, the characteristics will change. Besides, there is a great relationship between these 3 characteristics, making the magnitude of one affect the others. For example, a more liquid asset will have less risk and therefore will have a lower return. Here are some examples of financial assets, classified according to their level of liquidity. Money in legal course. Coins and banknotes. It has the highest degree of liquidity and can be exchanged directly for other assets. Money in the bank. Bank deposits. They can be savings, sight and time deposits. Short-term public debt. The famous treasury bills. Commercial paper. Assets issued by private companies to suppliers, etc. Long-term public debt. Treasury bonds and obligations. Fixed income. Debt issued by private companies. Variable income. Assets ranging from shares to financial derivatives. Historically, every era has its own appropriate financial assets, and one must adapt to change. There will be years when, as now, from 2015 to 2020, and it seems that for many years to come, the interest on bank deposits does not offer any kind of return, and there is no choice but to take risks and invest in equities if you want to make a profit from your savings. In other periods of rising interest rates, such as between 2005 and 2010, bank deposits offered a very attractive return, and the conservative saver could earn money very comfortably and safely. Your economic decisions can, in this way, follow a certain pattern that will help you plan for the future. High or rising bank interest rates. Money does not circulate and is directed to deposits. A large part of your savings should be in deposits or fixed income. It is a good time to buy a house in cash and without financing, because the real estate market does not move. Less demand equals lower prices. Low or falling bank interest rates. Conservative money doesn't get a return and is partly directed towards equities or the housing market. A greater part of your savings should be directed towards variable income. Bad time to buy a house. Low interest rates drive people to buy homes on credit and create housing bubbles. If you've bought a home as a cash investment in times of high interest, it's time to sell it and wait for it to rise again or for the bubble to burst. This is a long-term strategy, as you will see. In economics, there are two totally different and opposite types of investments. 1. Short-term investment. Short-term instruments are usually used by investment professionals, such as stock traders, or by people psychologically accustomed to large swings in their positions. The most representative financial asset of the short term is stocks, although in times of international tension or the beginning and end of periods of crisis, any asset can be used to invest in the short term. Short term means that in a small period of time, weeks, days, and even hours, the invested good can suffer a sudden appreciation or depreciation of its value. Later on, I will tell you about my experience as a very short-term stock trader. I wanted to describe short-term investing first, to introduce a very important concept. Long-term investments are usually the most profitable and should weigh more than any other in our portfolio. Here, a new concept has come into play that you will hear many times if you become a regular user of economic information: investment portfolio. An investment portfolio is the set of assets with which an investor or saver carries out his or her financial strategy. That is to say, it is the set of financial products and assets to which the saver allocates his money in order to obtain a return for it. The concept of investment portfolio introduces a global vision of our investments, taking into account the correlations that can occur between different assets. Thus, we can get an idea of the overall profitability that our portfolio can offer us, and also helps us in making strategic decisions. As I said before, I started with short-term investments to highlight their disadvantages. Short-term investment is not suitable for most investors. The ups and downs that stocks suffer in the stock market bring with them a psychological stress that can be addictive, and a psychological wear that not everyone can endure. Does this seem exaggerated? It is not, I assure you. I've been a speculator. Yes, that's the right term, and it's not at all derogatory. When you buy and sell securities in a matter of minutes, you are speculating on the value of these securities. And some days, I would make several $100,000 trades in a few hours. But during those years, on many occasions, when I compared the profitability and peace of mind my wife obtained with her long-term investments in shares of the company where she worked, I considered leaving it and changing strategy. Do not invest more than 20% of your savings in the short term. No, that wasn't enough. We have to do better. Do not invest more than 20% of your savings in the short term. Why so much attention to this advice? Short-term investment is always more profitable than long-term investment, therefore it is more spectacular and visible. The benefits are there instantly. For example, a $20,000 investment in low-cap, high-risk stocks in the continuous market can offer a 50% return in a single trading session. So the $20,000 you invested at 9 o'clock in the morning, at 12 o'clock in the afternoon, offers a profit of $10,000. You just made $10,000 in 3 hours. Now what? Of course you want more. If you can make that much in 3 hours, what would happen if you doubled the amount invested? You can try 40,000 next time, or 60,000, and you'd win. Error. 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 That is precisely what you have to avoid, and the great danger of investing in stock market shares. The next day you will try your luck again with the same value, and in this case, the most seasoned investors will reap their benefits, and the value, without any understandable reason, will fall by 50% that morning. So if you invested 60,000, you will lose 30,000 in several hours. What a disaster for your economy! Several years of work and savings, nothing more and nothing less, have gone to waste in a few hours. The psychological blow can be terrible. Watch out. At this point in the explanation, many books by famous investors will advise you to go back to the stock market the next day and try again, as they did well, etc. Error. 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 Let's make things right. We'll invest a maximum of 20% in stocks, better in assets of the main stock market indexes than in small capitalization companies, and something even more important. Never make decisions concerning the family economy alone. Always discuss your risky decisions with your partner or other trusted person. On many occasions, it is only one member of the family who takes the initiative in investments, and that is a big mistake. If your partner does not get involved because he does not like the economy, you should make an effort to make him do so, making him understand that economic decisions are, along with those of work and children, the most important of your lives and those that will most influence your future. 2. Long-term investments. There are basically 3 instruments with which you can invest your savings over a longer term than the direct purchase and sale of shares. Although it is true that you can also execute direct stock purchase strategies with a view to maintaining them over time, but this type of direct operation is always focused on the short term. The most typical long-term investments are bank deposits, government debt, investment funds, and pension plans. A. Bank deposits. Bank deposits are one of the most conservative investments that can exist, and always have to be in your portfolio, even though, as at present, they offer practically no benefit. They can also be replaced by liquidity in the bank's current account. Remember that our objective is to be able to subsist if we lose our job for at least 5 years, and a large part of our money has to be available when we need it, instantly. This is going to be the function of the bank term deposits and the current account. Term deposits can normally be contracted on the bank's website and can be automatically renewed when the contract ends. Following the 2008 banking crisis and the alarm raised among bank customers about their possible bankruptcy, the authorities rushed to reassure the population. There is a deposit guarantee fund for credit institutions, which aims to guarantee deposits in money and securities or other financial instruments held by credit institutions, with a limit of $100,000 for deposits in money or, in the case of deposits denominated in another currency, its equivalent, by applying the corresponding exchange rates. All banking institutions are obliged to adhere to this deposit guarantee fund, which covers the money in the accounts and deposits up to a limit. That is, if you have, for example, $14,000 in a current account and time deposits of $50,000, in case the bank suffers liquidity problems and has to intervene from the guarantee fund, you could recover the total money deposited in that entity, $64,000. Most governments have a deposit guarantee fund. Here are some examples. Germany, 100,000 euros. Austria, 100,000 euros. Belgium, 100,000 euros. Bulgaria, 100,000 euros. Cyprus, 100,000 euros. Denmark, 750,000 Danish crowns. Slovenia, 100,000 euros. Slovakia, 100,000 euros. Spain, 100,000 euros. United States, 250,000 US dollars. Finland, 100,000 euros. France, 100,000 euros. Greece, 100,000 euros. Hungary, 100,000 euros. Ireland, unlimited coverage. Italy, 100,000 euros. Nicaragua, 10,000 US dollars. Norway, 2 million Norwegian crowns. The Netherlands, 100,000 euros. Poland, 100,000 euros. Portugal, 100,000 euros. United Kingdom, 85,000 pounds sterling. Czech Republic, 100,000 euros. Sweden, 950,000 Swedish crowns. Switzerland, 100,000 Swiss francs. If two holders are listed on an account or deposit, the coverage is $100,000 each. That is, they could recover up to $200,000 if they have that amount deposited. If you have a larger amount saved in accounts and deposits, it is advisable to place those savings in several entities or in the name of several holders. It is important to know that money invested in investment funds or pension plans is not covered by the Deposit Guarantee Fund, although there is a mandatory separation between the institution managing the fund or plan. A pension plan is also a mutual fund, and the depositary institution. In case of bankruptcy of the bank where you have hired a pension fund or plan, these need not be affected because they belong to different companies outside the bank. B. Public debt or government bonds. A state bond is a type of investment based on the debt system, through which money is lent to a government in exchange for an agreed-upon interest rate. Governments use them to obtain funds that can be used for new infrastructure projects, and investors can use them to obtain a fixed return at regular intervals. How do government bonds work? When you buy a government bond, you are lending the government an agreed-upon amount of money for a set period of time. In return, the government will pay you a fixed percentage of interest at regular intervals, known as a coupon. This makes the bonds a fixed income asset. Once the bond matures, your original investment is returned to you. The day you receive your original investment back is called the maturity date. Depending on the bond you choose, you will see a different maturity date. You can buy a bond that matures in less than a year or one that matures in 30 years or more. Example of state bonds. Let's say, for example, that you have invested $10,000 in a 10-year state bond with a 5% annual coupon. Each year, the state will pay you 5% of your $10,000 in interest and when the maturity date is reached, it will return its original $10,000 investment. Types of state bonds. The terminology around bonds can make the system seem more complicated than it really is. This is because each country that issues bonds calls them by a different name. UK government bonds, for example, are called gilts. The maturity date of each gilt is specified in the name, so a UK bond that matures in 2 years is called a 2-year gilt. In Germany they are called a Bund, and in the US they are called a T-note. Other countries use other names for their bonds, so it is interesting to look up information about each country before you start trading. Index bonds. You can also buy government bonds without a fixed coupon. Instead, interest payments will move in line with inflation levels. Buying and selling government bonds. As with stocks, government bonds can be held as investments or sold to other investors in the open market. If we continue with our previous example, let's say your 10-year bond has reached half its maturity, and you have found a better investment elsewhere. You want to sell your bond to another investor, but because better investment opportunities have arisen, your 5% coupon now seems less interesting. To cover the shortfall, you can sell your bond for less than $10,000 of your initial investment. An investor who buys a bond will still get the same coupon, i.e. 5% of $10,000. But its return will be higher, since he has paid less while getting the same return. A bond whose price is equal to its face value is said to be a par bond. If its price falls, it will be a low par or discounted bond. If, on the contrary, its price rises, it will be an over par or premium bond. What factors influence government bond prices? Supply and demand. As with other financial assets, bond prices are determined by supply and demand. Each government sets the supply of government bonds, issuing more if needed. Demand, on the other hand, depends on whether or not it is an interesting investment. Interest rates can have a big impact on the demand for bonds. If interest rates are lower than a bond's coupon, demand for that bond will increase, making it a better investment. But if interest rates rise above the coupon rate, demand will fall. Proximity to maturity date. Recently issued bonds will be priced at current interest rates, which means that they will normally trade at or near face value. Once the bond reaches maturity, the initial investment is returned, so a bond will return to face value as it approaches this date. The number of interest payments remaining before the bond matures will also impact this price. Credit ratings. Government bonds are generally considered low-risk investments, as the chance of a government failing to make its loan payments is usually low. Even so, this can happen, and a bond with higher associated risk will usually trade at a lower price than a bond with lower risk and a similar interest rate. The main way to know the risk of a government not paying its debts is through the ratings of the 3 major credit rating agencies: Standard & Poor's, Moody's, and Fitch. Government bond risks. You may have heard that government bonds are risk-free investments. Since a government can always print more money to meet its debts, the theory holds: you will always receive your initial investment back at maturity. But the reality is more complicated. First, as we saw with the debt crisis in the 2008 to 2001 crisis, governments cannot always produce more capital. And even if they can, it does not ensure that they can afford to pay back the loans. In addition to this credit risk, there are some other possible dangers surrounding bonds, some related to interest rates, inflation, or the exchange rate. What is interest rate risk? Interest rate risk is the potential danger that a rise in rates will cause a drop in the value of your bond. This occurs because of the effect that high rates have on the opportunity cost of holding a bond, when you could actually get a better return on another investment. What is inflation risk? Inflation risk is the potential danger that a rise in inflation will cause a drop in the value of your bond. If the rate of inflation rises above the coupon on your bond, you will lose real money on your investment. Index bonds can help mitigate this risk. What is currency risk? Currency risk can only occur if a government bond performs in a different currency than its benchmark. If you buy a bond under these circumstances, any fluctuations in exchange rates could cause the value of your bond to decline. Getting started with state bonds. When a government wants to issue bonds, it usually does so through a bond auction, where the bonds will be purchased by large banks or financial institutions. These institutions will then sell the bonds, usually to pension funds, other banks, and individual investors. Sometimes the government sells bonds directly to individual investors. See investment funds. An investment fund is a collective investment institution, which consists of gathering funds from different investors, natural or legal, to invest them in different instruments. Normally, you invest in a mutual fund through the banks, although, as I said before, this investment will remain separate from the bank's assets in case the entity has problems. There is an immense catalog of investment funds according to their investment vocation, risk, type of return, or geographical area, among other parameters. This is a general classification. Monetary investment funds. These are funds that stand out for their high levels of liquidity and low risk. The return they obtain is low. They do not invest in equities, currencies, or commodities, and stand out for their similarity to money. Having so little variability and so much flexibility, we can quickly transform our holdings into money without losing part of our investment. Fixed income investment funds. They invest in fixed income made up of bonds, debentures, promissory notes, etc., from governments and companies all over the planet. The evolution of the value of these funds depends fundamentally on the evolution of interest rates. Variable income investment funds. They invest mostly in variable income, shares. They can be divided depending on the markets where they invest, Europe, emerging markets, etc., according to the sectors of activity, technology, telecommunications, or according to other characteristics of the companies. They are the ones with the highest risk and usually offer the highest return. Mixed investment funds. They are a combination of the two previous ones, a part of fixed income assets and another part in variable income. Depending on the percentage of investment in each one, a greater or lesser level of risk will be assumed. Global investment funds. These are funds that do not have a defined investment policy. They are funds that do not fit into any of the previous ones. They are free not to fix in advance the percentages they are going to invest in fixed or variable income. They do not specify the markets, nor the sector of activity or the geographical distribution. In this type of funds, it is possible to find high levels of risk. Guaranteed funds. They can assure total or partial recovery of the initial investment, plus a fixed or variable return at a certain date. There are guaranteed funds of fixed income and variable income. Alternative management funds or hedge funds. These are funds that are characterized by giving a lot of freedom to the management company, which uses the assets to perform risk hedging operations, increasing risk exposure in order to achieve a higher return. They use very complex instruments such as derivatives and take short positions. The minimum investment is $50,000. Funds of funds. They do not invest directly in securities, but in other investment funds. Index funds. These are funds that replicate the composition of a stock index. The main stock market indexes in the world are Europe, IBEX 35 Spain, FTSE 100 Great Britain, CAC 40 France, DAX 30 Germany, FTSE MIB Italy, AEX Netherlands, Eurostoxx 50 50 most important companies in Europe. Asia. Nikkei 225, Japan. Hang Seng, Hong Kong. Kospi, South Korea. America. Dow Jones, USA. Nasdaq Composite, USA. Nasdaq 100, USA. S&P 500, USA. Bolsa de Valores y Productos de Asunción, BVPASA, Paraguay. Bovespa, Brazil. Merval, Argentina. IGBC, Colombia. IPSA, Chile. IGBVL, Peru. CPI, Mexico. IBC, Venezuela. Indexed funds create a portfolio of stocks, with each of the values that make up the index. This form of management ensures that the fund obtains a performance identical to that of the index that follows. These funds have a passive management, which means that the manager tries to replicate the performance of an index, ETFs, whereas active management is to bet on managers who intend to beat a certain benchmark index. ETFs, an acronym for Exchange Trade Funds, have a special feature. They are market-traded funds that can be bought and sold, like any stock. It should be noted that investment funds have tax advantages over other products, because the capital invested in them can be transferred to a different fund or another manager without paying taxes. No taxes are paid until the fund is definitely sold, but in the meantime, that capital can be transferred from one fund to another to take advantage of the different contexts and returns of the economy. Pension plans. Pension plans are another great long-term investment option. With a birth rate pyramid invested in many countries, this financial product is becoming increasingly important among savers. It is basically about saving a little bit every month to have this money available at the time of retirement. There are different types of pension plans, which are actually investment funds. In each country, there are different regulations regarding taxation and the possibility of redeeming the money before retirement. In Spain, for example, pension plans are taxed very favorably and can be redeemed in cases of prolonged job loss or serious illness. In recent years, there has been discussion about the possibility of recovering the money invested in a pension plan after 10 years, although, in my opinion, this distorts the mission of this type of instrument, which is saving for old age. In the United States, a country whose public health coverage is limited to basic services and left to the private sector, there are two savings systems. 401k system. It is a pension plan promoted by companies and where the worker invests part of his or her salary. The worker will be able to match the contributions made by the employer and will enjoy important tax incentives. IRA system. It is an individual savings system that allows individuals up to 50 years old to invest a maximum of $5,500 and individuals over 50 years old to invest $6,500 without tax effect. The condition is that this investment can only come from your annual income. I always say that if when the time comes for my retirement, I find a capital saved during my whole life in my pension plan, two circumstances may occur. 1. That, thanks to my good economic decisions, I am in a comfortable financial position and do not need the money. In this case, I will give the capital to my children, who will be in the time when they will need an economic boost. 2. That due to life circumstances, things have not gone well for me. If this is the case, it will be very good for me to find capital saved at the age of 67. As for the decision to hire a pension plan or not, I recommend you to do it. Although the latest changes allow you to redeem the money at 10 years, having that capital set aside will encourage you to move forward. The advantage of pension plans is that you invest normally a fixed amount per month that goes up a bit as stipulated by the hiring party. You can make contributions, for example, of $50 a month or $100 depending on your income. This form of investment over time allows you to take advantage of the ups and downs of the markets. The pension plan is divided into shares, which are assigned a monetary value. Each month you invest, for example, $50 in a plan whose share has a value of 25 cents. In this case, 200 shares of that plan. Every month, the value of the participation is reviewed. If the plan changes in this value, because there has been an economic crisis that has affected the stock market and it falls, for example, to 11 cents, the next month you would buy the same $50,454.54 worth of plan shares. This assumption really happened in the crisis of 2008. The value of my pension plan suddenly fell by more than half. This caused me to panic at first, but then I realized something. If my pension plan had fallen by half, but I was still buying $50 every month, then for the duration of the financial crisis, I would be buying twice as many shares as before. When, after 5 years, the stock markets recovered and the pension plan returned to its pre-crisis value, I had been buying twice as many shares of this plan during those 5 years. So now the value of my investment had not only recovered, but had increased twice as much. This is an example that things are not always positive or negative. In the event of a crisis, there can often be a middle ground working in our favor. Like mutual funds, pension plans can be conservative fixed income, risky equity, and mixed. The decision to hire one type of plan or another will depend on your time horizon. If you start with the plan in your youth, you have to invest in one that has its capital 100% in variable income, because the variable income is the one that better takes advantage of the long period, that can be up to 50 years, in which you will be contributing money monthly. But be careful when your age approaches 60. What should never happen is to reach your retirement with a pension plan invested 100% in variable income. What would happen if the year you reach your retirement, a crisis breaks out and the value of your pension plan falls by half? You no longer have time, thanks to the low value of the share, to buy many shares and wait for the markets to rise again, because that will take years to happen. To avoid this catastrophe, between the ages of 50 and 60, you have to analyze your pension plan and, taking advantage of a good year in the stock markets and a high value of the share, transfer your plan to a conservative one. In this way, you ensure that in the last years of the plan, it does not suffer fluctuations, and your investment, although it will not increase its value much more, does not lose money before you reach your retirement age. Invest in a risky pension plan if you have a very long time horizon. Transfer the plan to a conservative one if you are approaching retirement and are invested in equity. Well, we have finished the section on investment in financial assets. At this point, I will give you another piece of advice, one of the last, very important. You have to see your investments together, never separately. And never dedicate all your capital to the same investment. Diversify it. Diversification of your investments is crucial. Only in this way will we avoid a crisis or a bad decision to destroy our economy. A well-diversified portfolio should have a large part of fixed income and another much smaller part of variable income, and if to this portfolio is added, when the capital is sufficient, an investment in housing without any debt, intended for rent, for example, or waiting for the real estate market to revalue to sell it, much better. Then you will have reached your goal, and together with your work and your savings, you will reach a full balance and prosper in your life. Let's go with a practical example adapted to today's times. Earlier, I said that interest rates in the world are very low and will remain so for years because central banks do not want money to be held in deposits, but to move to stimulate the economy. This means that fixed income, the least risky, hardly offers any return. The dilemma is this: I don't want to risk my money, but how can I get a decent return? The solution is, as also said before, to look at your investment as a whole and not separately. If you want the base of your savings to be as solid as possible, the top of the pyramid can swing a bit without the building suffering. The ideal decision in this case would be to invest 90% of your portfolio in very conservative funds with a low expected return, e.g. 1% per year maximum, but with zero risk of loss. And the remaining 10% could be invested in equity funds at an expected return of, for example, 15%, but with a high degree of volatility. Let's translate this into actual figures with a portfolio of $100,000. The bulk of the investment would go, as we said, to capital preservation funds. The rest, the top of the pyramid, to equities. If things go wrong and you lose on the equity side, let's say, for example, a 10% loss in the year, the initial €10,000 invested in stock funds would become $9,000. But the remaining $90,000, which can perfectly well make a profit of 1% per year, would become $90,900. If the investment is seen as a whole, in the worst scenario, you would have invested $100,000, and you would have $99,900 left. You have lost $100. But if, despite the intrinsic volatility of the stock markets, the $10,000 invested in equities becomes $11,000 or more, a 10% stock market return over the year, 12 months later you will have $101,900, 90,000 1% plus 10,000 10%, almost 2% per year in the best scenario, and in the worst, the risk of loss would be only 0.1%. 2% if the stock markets rise, 0% if they fall. And falling by 10% in 1 year is already falling. But even if it were 15%, it would not be enough to cry. The portfolio would barely notice it. And as always, great care with miracle products. On the way, you will meet vultures waiting to tear out pieces of your savings before you have died, and in this context of low interest rates worldwide, they will offer you to earn more than 2% with total security. That's a lie. You are being cheated. And on top of that, you'll probably be hooked for many years on a product that's going to cost you to get out of, because the trick, their profit, is in the redemption fees. Let's review the basics of our healthy and effective financial situation. 1. Work. 2. Investment in housing with minimum debt. 3. Savings and pension plan. 4. Absence of mortgages and credits. 5. Investment in conservative products with a minimum amount of risk. 6. Financial cushion in case of job loss or illness. 7. Comfortable old age without having to think about money. I know that this may seem utopian, and that along the way there are many factors that will make our financial building rock, but first of all, you have to think about where you come from and what your goals are. If you don't make the right financial decisions, your life is going to become this. 1. Work. 2. Oversized mortgage. 3. Zero savings capacity. 4. Installment purchases, car, appliances, etc. 5. Debts added to the mortgage. 6. Possible foreclosure of home due to loss of employment or health problems. 7. Retirement with debt and zero savings. 8. Aging with economic hardship. Not being able to help your children in case they need it. It is clear that of the two scenarios, you will choose the first one. That is the reason why you are reading this book, for which I thank you very much. The next level in your economic well-being is business, making your money work for you on a large scale and expanding your expectations to infinity. I will develop the section on business investment in another manual, but, by way of introduction, at present, there is a difference between being a businesswoman or an entrepreneur and being an entrepreneur. The businesswoman or man usually has the ability to adapt to any sector or type of business, if she or he detects an interesting opportunity. The entrepreneur usually focuses on developing his or her own ideas, or those with which he or she has a great personal involvement. The aspects that describe the businesswoman or man are more related to the classic term boss. She or he is a person who has to earn a salary for her workers, as well as for herself. Her expectations of success are usually higher, since several people depend on how her work works. The entrepreneur is not unconnected with the economic level, but her motivation is more directed to the fact of getting ahead with her project and leaving a mark in some way. Does that mean that she doesn't care about money? Not at all, but she thinks more about working on what you like and you will never have to work. Of course, you have to live from your company, and economic success is what motivates you to continue. Many businesswomen and businessmen were first entrepreneurs. They wanted to develop an original and exclusive idea that later became a solid and sometimes international company. The fascinating world of business will be developed in the following manual. Be sure to read the series Yes, I Want. Yes, I Can to improve your life. Go ahead, you are on the right track. You will make it.